In this week's video, we'll review the latest charts and data to help us answer the question, what's next for stocks? Final capitulation or liquidity-induced rally? We'll be moving quickly, so feel free to use the pause button on your video player. A week ago, on Friday, March 10th, regulators took over Silicon Valley Bank. And before the market opened on Monday morning, officials said they were going to back all deposits regardless of the FDIC insurance limits. There are still numerous outstanding issues if we fast forward a week later, including volatility in Credit Suisse and ongoing volatility in First Republic, regional banks in general, and banks in general. Near the close on Friday, First Republic, Regional Bank ETF, KRE, and XLF, all near the session low, Schwab started to distance itself a little bit, closing closer to the session high. From a risk management perspective, we're not making any assumptions about anything. We've added a second money market fund to the mix. It invests 100% in U.S. Treasury bonds. If for any reason we feel that it's prudent to move almost all of our assets into this fund, we will do so. We don't believe that's the case at this point, but we're keeping an open mind. For clients or anyone else that's interested in learning more about Schwab, there's a live link on this week's Short Takes post. You can find a link to the Short Takes post on our Twitter feed at Shavaco Capital. You can also Google Shavaco Capital Short Takes. The video that you can access from this link makes some important distinctions between a brokerage firm, where 100% of our assets are custodied on the brokerage side, and a bank. We don't have any client assets at Schwab Bank. The key takeaway is, if your money's at a bank, for the most part, it can be loaned out. That is not the case with a brokerage firm. Schwab doesn't commingle their assets with our assets. They reside in separate accounts in our name. For the most part, SIPC insurance protects us against fraud. Every bank is susceptible to a bank run. That's not true at a brokerage firm. If every client at Schwab asks for their money tomorrow, the money's there. They could deliver. I'm speaking in general terms here, but that's an important distinction between brokerage firms and banks. If you're a client, if you have any questions, feel free to ask. It's very, very difficult to envision a sustained rally in risk assets with regional bank stocks still trading in this manner. It's troubling after this statement that this stock here hasn't calmed down yet, including losing 32% during Friday's session after this statement was made, and losing an additional 14+% after hours on Friday. Now, obviously, all of these quotes could be green on Monday morning, and these stocks may bounce back significantly next week. Hasn't happened yet. This is the data in front of us. And it's very, very easy when we see headlines like this and quotes like this to take an extremely short-sighted view of our investments. But there will be another side of this, and we all have goals and objectives, longer-term investment goals and objectives that remain relevant. It's a big spike in the Fed's balance sheet, COVID, right here. And as you remember, the stock market rallied sharply. Here's the spike this week. Make an argument that this spike here is very, very similar to the spike on October 1st, 2008. Stocks did extremely well, in this case, the 2020 case. They did not perform well at all walking forward from October 1st, 2008. This is the S&P 500 here. This is where it finished on March 9th of 2009. In terms of the significance of this move here relative to risk assets, it really depends what the Fed does next. In Europe, you may remember in October, they stepped in and bought distressed securities. That was a temporary situation. They didn't let it derail their fight against inflation. In fact, the ECB raised interest rates by 50 basis points this week. It's possible that the Fed is going to do some offsets relative to this spike here. They could continue QT. They could increase QT. They could continue to raise rates. But if they don't do that, Liquidity is liquidity, and this is relevant. If I'm a bank and I'm getting assistance, it may prevent me from selling securities, so it impacts market functioning, and it impacts it in a positive manner in the short run. And as noted by the Wall Street Journal after the close on Friday, almost all of this spike they believe is associated with just a handful of institutions. So we really can't read into this that we have a widespread problem. We don't know that yet. The data doesn't really seem to support that theory. So what happened this week is not QE, but it's still liquidity being added to the system, and it's still an expansion of the Fed's balance sheet. If nothing else, this spike in the Fed's balance sheet helps us keep an open mind about much better than expected outcomes. In the 2008 case, helps us keep an open mind about much worse than expected outcomes. So this huge spike here in October of 2008, that was not QE. QE1 had not been announced yet. It was borrowing from the discount window. This is '08. This is what happened this week. Again, both are relevant, but they can't be viewed in isolation. The two big wild cards are, what are the external factors? In '08, they were horrible. And what does the Fed do next relative to this spike? Are there offsets coming? This blurb here is from the Fed's website relative to the discount window. The objective of the discount window is significantly different from the objective of QE. As of the close on Friday, March 17th, we need to see some significant improvement before we switch from a defensive incremental strategy to something else, and we just don't have that yet. This is KRE. While it didn't make a new intraday low on Friday, it made a new 52-week closing low. And that's after this, and that's after this. And we have to keep in mind, this appears to be a very rare and abnormal move over here in KRE, the regional bank ETF. This is also a very rare move. It just happens to be to the upside. So you can make an argument that this is somewhat of an artificial move here, and we're just retracing that artificial move. Probably fair to say that's a hot knife through butter look. And you may remember from past videos, we said in bear markets, your leaders can take on constructive looks relative to their weekly cloud. But if we're in a bear market, they're most likely going to fail, and the market itself will never take on this look. Well, right now, that's what we have. A lot of examples of that, or examples of leaders that look like they're in the process of failing. And in terms of some of these banks getting in trouble, the Fed told them here that they were going to keep rates low for a long, long time. Thus, buying 10-year treasuries really didn't appear to be risky at this point in time based on the Fed's promises. This headline here, August 27th of 2020, that's roughly right here. Look what happened right after that. A lot of experience here. Takeaway. At the present time, there is no credit crunch. Remember we said last week that markets are very, very difficult when we have interest rate volatility. We still have rare interest rate volatility. It's hard to believe this chart here is only 7 trading days in the rearview mirror. This is after the open on Thursday, March 9th. These are the areas of potential support that we're watching. Now here's the bad news. On Friday, we closed below basically the intersection of the 200-day moving average on the S&P 500 and the volume-based price line tied to the October low. Now, we undercut that line at the December low. It's still relevant, but it's not earth-shattering at this point. You can see price respected this VWAP line here in purple and this line here in green. Purple tied to the COVID low, green the COVID high. So as of Friday's close, we still have at least three areas of possible support in the neighborhood, relatively close by. So we'll learn something soon. However, right now, the longer we stay below this, and this, the more concerning it becomes. Obviously, this is an important area right in here. But we could bounce right back above all of these levels very, very easily on Monday morning. This is S&P 1500, extremely broad. We'll learn something very, very soon. This is why some patience is absolutely warranted based on the data. COVID high, COVID low, October low here. Price right in that general area. Things can improve significantly if we move in this direction, and they will deteriorate rapidly if we move in this direction, especially if we undercut this low here. Now, these aren't the only areas of potential support, but these ones are important. And as of Friday's close, we're still very much in the vicinity of these areas. That may change very, very soon. It just hasn't changed yet. The moves that we saw this week are extremely rare. Only 2 times in the history of SPY and RSP have we seen something similar. One of them, extremely bearish. We got a big move to the downside after October 17th, 2008. Stock market didn't bottom until March of 2009. Really the polar opposite here, but also a big move. This one was to the upside after the COVID low. This is the type of look, a coiling look. Price has been moving sideways for several months. Pretty easy to understand how we could get a big move in this direction based on the chart, or a big move in this direction. How will we know? Price will be our guide. The further we move in this direction, the higher the odds are the break is to the upside. The further and longer we stay down here, the higher the odds are that the break is going to be to the downside. We really don't have to wait much longer to get a lot better information, potentially. There's nothing that says the market can't continue to go sideways. Remember last week we said things still look pretty good around lunchtime on Thursday, March 9th. These lines speak to the entry points of market participants. For the most part, the average participant from this point here, the orange line, is profitable when price is above that line. It's much, much easier for them to hold or add. When we drop below the line, the average participant, based on volume and price from this point here, is underwater, and thus it gets harder for them psychologically to add, and it gets easier for them to sell based on sound risk management habits. So think add above, easier to add above, easier to sell below. So this is the look of the chart last Thursday. This is the look of the chart last Friday. Still had this area of potential support and this area of potential support. If we fast forward a week, this is getting more concerning. Up here a very short time ago. When we're up here, we've cleared some very, very significant levels. Now we're below all of them. However, we undercut that level here in November. That's a short stay. If we can pop right back above, this gets a little bit more constructive. But you can see the convergence of the lines here and price moving sideways. It aligns with this. Either a big move to the downside could be coming, very easy to understand that, or a big move potentially to the upside. Now, this type of move here is extremely rare. And in terms of this being a reflection of increasing fear, it's basically unprecedented in the bond market. The last 7 trading days, so going back to last Thursday when we said around midday and in the morning things looked pretty good on the 9th. Over the last 7 trading days, we had the fastest move in the 2-year Treasury yield, moving from a 6-month high on the 8th to a 6-month low on the 17th. That is an extremely rare, in fact, in the bond market, unprecedented spike in fear. I think you can make an argument that it's very, very similar to this spike here. During the financial crisis, bad things happened after this. In this case, the Fed was able to, for the most part, bail out the markets, and after this spike in fear, good things happened until the peak in the year 2000. It's going to be much, much harder for the Fed to engineer something like this relative to this. Remember last week we said markets are much more difficult when there's high interest rate volatility. This is just incredible here. This is interest rate expectations, how they've shifted day by day. March 8th up here, March 9th, March 10th, 13th, 14th, 15th, and 16th. Again, unprecedented in terms of what happened with the 2-year. These things don't happen very often, which means on the other side of this, at some point, things are going to get easier. That's just the way it works. Things did get easier after the financial crisis. This really speaks to Fed policy. This is exactly what the Fed wants to avoid. That's why they talk all the time. They're trying to set interest rate expectations so the market understands where they're going, so we don't get volatility like this and we don't get crashes, mini crashes like this. It hasn't worked out real well lately. You may remember in last week's video we said it's possible that the tech sector was going to pull the S&P 500 higher. This is XLK on March 9th. So with interest rates plunging, primarily based on fear, been a big shift. XLK has held up well. So we can learn something about the probability of the market rallying by monitoring XLK. The longer XLK can stay above these lines, the higher the probability that SPY or the S&P 500 can hang in there. And the further it can move away from these lines and the longer it stays above, the higher the probability that this type of look in the general market, this convergence, coiled look, could break to the upside. Conversely, if the look of this chart morphs into something like this, so this chart looked very, very good up here. If we see something similar here, concerns would increase. Hasn't happened yet. This is the look of the chart on March 17th at the close. So stock market bulls want to see this, and this green. They were all green during the day on Friday, March 17th. They all finished red, but still hanging in there well. If you want to keep an open mind about better than expected outcomes, just look at this chart here and look at momentum turning up here above the zero line on the monthly chart. If you want to keep an open mind about worse than expected outcomes, and you want to keep an open mind about this chart here morphing into something more like this in the next couple of weeks, then you can look at this chart here of bonds. So this is really a way to look at interest rates. This is IEI. This is the weekly cloud as of the close on the 17th. This is potential cloud resistance in here. We've rallied right back to the bottom of the cloud. So it wouldn't be shocking if the Fed created an about face here next week. That's to be determined. This is the chart in front of us. This is potential or possible resistance that could impact this and all of these, either favorably or unfavorably. Similar situation with Apple. The weekly chart has come right up to potential cloud resistance. Apple makes up approximately 23% of XLK, one of the largest holdings. We learn something about bullish probabilities if we can get to this side. We learn something about bullish probabilities if we can get across, similar to this cross here after the stock market made its final low in October of 2002. On the concerning side of the ledger, XLK2, potential weekly cloud resistance. We're just back into the cloud. You can see the interest rate expectations shifted significantly. Look at this move. QQQ divided by RSP. It went straight up, including gapping up today on Friday the 17th, leaving the gap there. You can make an argument that's similar to this look right here. And this is as the NASDAQ is peaking, and you can see the S&P 500 peak soon thereafter in early January of 2022. Not a prediction in any shape, form, or fashion, but if you study markets, it's not likely that a vertical move like this is going to continue indefinitely. So we'll learn something based on how this ratio acts next week. Right now, it's above all of the moving averages and has made a very, very significant move from here to here. S&P 500 weekly cloud. This is 2:05 p.m. on Friday. Momentum weakening. The cloud has acted as resistance thus far. That's concerning. A couple of positives here. This isn't at the close, but The S&P 500 finished the week green. The weekly low was made at 9:38 on Monday morning. So we want to keep an open mind, especially when we have a chart like this. This chart calls for continued patience with some of our risk assets. Even in the short run, price has been coiling near the 50-day, the 75-day, the 100-day, the 125, 150, and 200 in orange. The consolidation, for the most part, started in May or June of last year. And while the S&P 500 is holding above a volume look like this currently, a similar spike on volume by price, the NYSE composite is below it, the Dow is below it. But right now, the S&P 500 is still hanging in there. And it is possible that we do not have a widespread problem. That is not a prediction. And right now, we do not have a credit crisis. It doesn't mean credit is going to be readily available going forward, but right now, there's no credit crunch. If you're a stock market bull, you'd really like to get back above 40.50. It's a weekly pivot in here for this week, and you'd really like to get above the cloud. So again, this is 2 p.m. on Friday. S&P was down roughly 37 points. It finished down 43 points for the daily session on Friday the 17th. That puts us below the 200-day moving average. It wasn't long ago that we were above the 200-day and the 50-day. Now we're below the 200-day and the 50-day, and we're below the 20-day. And you can see here, we could not clear the 20-day. What once acted as support back here recently acted as resistance. So if you're a stock market bull, if you can get back above 40.25, even that, things start to look better. We're not there yet. You can see this is the low made basically at the open on Monday morning. This is Monday, Tuesday, Wednesday, Thursday, Friday. If we drop down here next week, concerns increase. We don't have any definitive resolution here. This ratio is sitting right at the intersection of the 200-day and the 50-day. This is an impulsive and potentially bullish candle on Thursday. Make an argument it's similar to this impulsive looking candle here. Price also made a stand down here this week near the November and December lows in here on the S&P. And IEF interest rates, we didn't get a fear breakout yet in defensive assets. And while the rollover look on the 30-week here in the S&P 500 down here in the lower right-hand corner is not confidence inspiring, price is still hanging right around the 30-week. We closed at 39.16. The 30-week is 39.13. So the next move, up or down, the further we can get away from the 30-week in either direction, we'll learn something. The low on Monday and this look here on Thursday and the fact that we're holding in this area thus far says don't fall asleep on the bullish scenario. It's not quite dead yet. Here's another impressive, impulsive look at an important spot. This is Microsoft weekly. This is the downward sloping trend line for the bear market. This is the 200-week moving average. This is a very, very important stock. This would be the good news. The bad news, we haven't cleared the cloud yet. So this is potential resistance in here. So we'll learn something either way here, but that's impressive looking in its present form. There's a tweet from Thursday. If good things are going to happen in the stock market, we need to be able to clear these lines that are tied to the December low in the S&P 500. This is SPY. This was a tweet from Thursday. Friday, we were down. SPY was down 1.14% for the full session. So we did not clear these levels. Doesn't mean they're insurmountable, but thus far, it's telling us if we're down here, the rally off of this December low is in doubt. If we can get back above it, it starts to become more meaningful again. Still have the coiled look. We'll learn something very, very soon, you would think. In its present form, this is about 95% hot knife through butter and not looking good. If you can move a little bit further in this direction, it will look even worse. Longer below, the more meaningful it becomes. You can pause your video player here. This is tied to the NASDAQ. This is a strong conviction move. This is 2009. This is the present day on the 15th of March. This is the long-term version of the indicator. This is the medium-term version of the indicator. And this is tied to the NASDAQ. This is supposed to be the indice that's supposed to lead us out of the woods here. This needs to improve. It may improve, but that's not a good look as of March 15th. See the medium-term look in the present day? This is a strong conviction move here. We don't have it anymore. Look how long the strong conviction move held in the 2009 case. The S&P 500 bottoms on March 9th, 2009. This is the S&P. And look at the conviction in that indicator for months and months and months and months and months. This conviction here thus far hasn't even lasted 2 months, and it's already rolled over. Not a prediction in any shape, form, or fashion, but this unequivocally is not the same type of bullish conviction that we see in this case. So this is the medium-term version again. This is the present day or earlier this week on the 15th. Now, you can make an argument. Is it possible that we've made the low? The S&P 500 made the low, the final low in October of 2002. And then we did have somewhat of a weak look in the same indicator. Eventually, conviction returned in March of 2003 on the retest. As the retest in the market, it makes a higher low, but really comes back almost to the same level. So we really want to see something like this to get more excited about the stock market. You can pause your video player here. This is the constructive look in 2003 when conviction is strong. This is the retest look. Conviction is strong 2009. Conviction is strong after the 2016 low. This is the present day on March 15th. Really like to get something that looks more like this. It may happen, it just hasn't happened yet. We haven't done enough here as of Thursday the 16th to take ourselves out of this year 2000 look or this 2008 look. This is what we want it to look like. Netflix, Friday the 17th, had recaptured this gap here earlier in the year. Now we've given it back. Is it logical to think the NASDAQ could make a stand relatively close to where we are today? Absolutely, positively, yes, is logical. This is Thursday around 2 p.m. Eastern. This was up over 4% for the week, but we still have this look here that looks more like this in its present form than this strong conviction move in 2003 or this strong conviction move after the major low in 2009. We need to see more here. Remember, we said leaders sometimes take on a very constructive weekly cloud look during bear market rallies and then fail. There's your constructive look, held the cloud on March 3rd. This hasn't failed yet by any means, but this is not a strong conviction breakout above the cloud. If you're a stock market bull, you want to get over here very, very quickly. If you're a bear, you really want to see this down here. We'll see how it plays out. It's not dead yet, but looking very vulnerable. Just the mirror image here. Defensive asset above the cloud. Cloud acting as resistance. Not a good look here. If we're in a rip-roaring bull market, we don't expect to see something like this, or we don't expect it to remain in place for very long. You need to pop right back above. Similar situation here. This is not a strong conviction new bull market look in its present form. It's really more of a potentially failed breakout look. XLK looking good this week on Thursday, but this is potential cloud resistance. We'll learn something either way. You can see the S&P 500 came up into the cloud, and thus far the weekly cloud has been rejected. Market leader taking on a potential failure look. Still a lot of good things happening here. Blue above red, lagging span above price. The cloud has shifted from red to green. So all is not lost here, but price looks pretty vulnerable. Similar situation here. A market leader had a very constructive look, now looking quite a bit more vulnerable. This is the NASDAQ during Friday's session. This is weaker potential resistance in here. This is stronger potential resistance in here. This is the look that we talked about weeks ago that we said we didn't want to see. Semiconductors up to the top of the cloud. Friday they were down. This would be the good news. The cloud has flipped from red to green, and we're still checking A lot of bullish boxes. We just need to get to the other side here and hold the green cloud. There's nothing definitive here. But we need to acknowledge above the Bollinger Band here and then back in. Above the Bollinger Band here, then back in. Close to being above here. We were above here, and then eventually momentum wanes. Monthly momentum here, a waning look. Black below, red here, here, here. Now this doesn't look nearly as bad as this or this. It just looks more vulnerable. So the weekly cloud looked a little shaky, but the daily chart hasn't given up some very important levels as of the end of the week. This was the low on Wednesday, had a nice rally on Thursday, and thus far holding above this level here and above all these moving averages, including the 225-day in black, the 250-day in teal. As far as the Fed's balance sheet goes, liquidity is liquidity. An expansion of the balance sheet in any shape, form, or fashion is relevant. Having said that, emergency lending to a handful of banks, and the handful comes from the Wall Street Journal, that adds liquidity to the system, just as QE does. It is a different mechanism, and we really don't know if the Fed plans offsets, meaning continue QT, increase QT, continue to raise rates. That's really the million-dollar question. We'll learn something about that next week. We have a Fed meeting. There's a big spike in the Fed's balance sheet in 2008, and really bad things happened. Not a prediction in any shape, form, or fashion. But in this case, Lehman was allowed to fail. Thus, there's a significant difference between 2023 and 2008. The longer the liquidity remains, the more relevant it becomes. We should learn something about this question next week. And typically, the FDIC is going to take over a bank after the close on Friday. Thus far, seems like we made it through this Friday with no new news on this front. Maybe it is just a handful of banks. Only time will tell. We're talking about a credit crunch. We just don't have the data to back that up yet. We could show a ton of charts to back up this first bullet point. And we could show quite a few charts to back up this bullet point. And we've shown some of these, and we've shown some of these, including the S&P 1500 and the S&P 500. If we move away from the clusters or the potential areas of VWAP support, bullish odds could deteriorate from this type of look very rapidly. Conversely, if the S&P 500 gets above that moving average cluster and recaptures those VWAPs, and XLK rallies to the upside, and the NASDAQ follows, and the standard weight S&P 500 with a heavy weight to XLK rallies, bearish odds could deteriorate very rapidly. But right now, the Mo favors things deteriorating, and that's reflected in our allocations, and the top bullet point is reflected in our allocations. Tech is important, and the Fed is obviously going to impact tech one way or another, and thus will impact the S&P 500. If you follow the Fed and the ECB, they've both said that for the most part they haven't used this term, but they're using a divide and conquer approach. What does that mean? That means they're using the special lending facilities and tools to deal with financial stability issues. So with the way that they've said they're going to deal with financial stability, and thus far their actions say you'll handle this separately from this. What does that mean? That means most likely the Fed is going to continue to focus on inflation, and if they feel that they need to continue to raise rates and continue quantitative tightening, they will continue to do that. Is it true that this and this are almost polar opposites? In this case, you're basically expanding liquidity. Here, you're basically withdrawing liquidity. They're almost polar opposites. It's like raising rates and lowering rates. The mechanism is a polar opposite, but it doesn't mean they're going to be doing both indefinitely. This could be relatively short term, and then this could be the only game in town. That's the Fed's call. Right now, the market thinks there's a 60% chance roughly of a 25 basis point hike next week. Given concerns about deposit flight, regardless of the facilities the Fed offers, Common sense tells us management at banks may be reluctant to lend money because they're afraid deposits could leave. And if credit does get tighter, and you could see how that would happen, no question recession odds would increase, could be a drag on earnings, and then valuations become even more concerning, hypothetically. We can talk till we're blue in the face about whether or not the Fed's balance sheet expansion is bullish or bearish. We really don't even need to know that. We just need to pay attention to the chart in front of us. If it's bullish, certain things will happen, and if it's bearish, certain things will happen. If it's more like 2008 and it's based on fear, the chart of the S&P 500 will move away from the moving average cluster, and it will move away from the multiple month period of consolidation, and it will move in this direction. And if so, we're very defensive now. We might even become more defensive. It's easier to move away if those charts shift a little bit. And we don't know if the Fed's done raising rates, and thus, the high-yielding money market funds are attractive right now. They try to maintain a dollar being worth a dollar. That's not going to be true if we start buying bond ETFs. We may do that, but bonds haven't clearly broken out yet. So we have two money markets right now. They can help us with toning down volatility. They can help us make some money. And they're very, very liquid if an opportunity arises sometime in the coming days, weeks, or potentially it may take months. How is it possible for stocks to rally? We've shown charts. The chart of the S&P 500, that setup is better than most would probably guess. And liquidity is liquidity. Right now it's relevant. The Fed may change that. And it is possible that the Fed is getting closer to backing off on rates. And it is possible that all the rate increases that they've done in the rearview mirror are going to bring down inflation. Sentiment has been lopsided and bearish for a very long time. Thus far, the economy has been relatively resilient. We've got favorable demographics in the United States, not in a credit crunch, and markets have been basing for a long time, including credit. Got a lot of potential inverse head and shoulders patterns where we've already formed the left shoulder. The head, in many cases, is the October low, and we may have some work to do on the right shoulders. And since that's happening in credit, sometimes that leads the stock market. Look at the chart of the S&P 500 and look at the chart of the S&P 1500 that we covered in this week's video. It's pretty clear that some patience is still in order here. That may not be true in one or two sessions, but it is at the present time. If the market moves to the upside, that patience will pay off. We can't assume with that liquidity injection that a violent rally is off the table. It is possible. Having said that, we've shown a lot of charts that say we need to continue to respect risk, and our allocations reflect that. At some point, there will be another side to this. We still have to think about that mortality table and our longer-term goals and needs. And as we all know, when we have coiling markets and indecisive setups, the only way that we're going to handle that properly is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.